Hey there, ambitious entrepreneur. Let's talk assets. You've heard the word, but what exactly is an asset? Think of it as any resource you own or control right now that can bring future economic benefits to your business. That might be physical, digital, or even intangible. 1. Types of assets. You'll bump into tangible assets. Current cash, inventory, receivables, things that turn into cash within a year. Fixed, long-term items like equipment, office space, computers, your day-to-day tools. Intangible assets, intellectual property, patents, or proprietary code your startup develops. Goodwill, your growing reputation, brand recognition, partnerships, digital assets, software, user data, algorithms. Think of tech-driven value. Financial assets, cash equivalents, bank deposits, treasury bills, equities, or bonds, grabbing a stake in another venture or fixed income instruments. Real assets, property, land, infrastructure, often more relevant if your startup touches real-world infrastructure or logistics. 2. Why assets matter for your startup. Securing capital. You can borrow against receivables or equipment, giving you cash flow without diluting equity early on. Strategic financing through leasing. Want machinery or tech without upfront costs? An operating lease provides flexibility, and a finance lease can eventually transfer ownership, creating asset-backed revenue. Once your business matures, you can bundle things like user subscriptions, loans, or royalties into tradable securities, boosting liquidity and scaling options. Building startup value. Investors don't just look at your cash, they zero in on your IP, tech, team reputation, and financial assets when valuing your company. 3. Valuing your assets. Historical costs, what you paid. Fair market value, what it could sell for today. Depreciation, amortization. Common accounting for equipment depreciated or patents and software amortized. For startups, valuing intangibles like user data or IP challenges investors but often becomes the true value driver. 4. The power play. Using assets to grow collateral for smart borrowing. Use equipment or contracts to negotiate better financing terms. Leasing for cash efficiency. Access premium tech or space now without the capital outlay. Asset-backed securitization. Years down the road, you might pool recurring revenues or licenses and sell them to investors, freeing up your capital for new growth. 5. Weighing the pros and cons. Pros, better cash flow management, ability to borrow at lower rates, less reliance on equity funding, stronger startup valuation. Cons, risk of losing assets if you default, accounting and valuation complexity, especially for intangibles. If assets depreciate fast like tech gear, you might end up owing more. 6. How this plays out for you. Leverage your tangible assets, equipment, inventory to unlock better financing and avoid giving away equity too early. Develop and protect your intellectual property. Even basic patents or proprietary code can become attractive collateral or value enhancers. Plan for digital asset growth. As your user base, data, or platform grows, so does your ability to monetize it in new ways. Explore alternative financing like private credit funds that have an appetite for asset-backed lending, even for startups. Final takeaways for a young entrepreneur. Understand what you've got. List both tangible and intangible assets your startup owns or controls. Use them smartly. Don't just hold them. Leverage them in financing deals or leases. Think ahead. Monetize assets not just for day-to-day needs, but as strategic tools for fundraising or growth, whether through securitization or licensing.